Welcome to the deep dive. We're here to cut through the noise and really focus on essential insights, especially where innovation meets critical health challenges. Today, we're plunging into something huge, the global threat of sight-threatening eye diseases. It affects millions. But the good news is the innovation happening in health tech, it's incredible, truly impressive stuff. Our mission today, a really deep dive into one company right at the forefront, Revenio Group. They're a specialized Finnish health tech firm making serious waves in ophthalmic diagnostics, basically, the tools doctors use to catch eye problems early. And we've gathered a lot of material here, a really rich stack of sources that paints a detailed picture of this niche leader. We'll look at their tech, how their business model is changing, their financials, their future plans. And for you listening, this isn't just, a company profile. It's about understanding how specialized tech, smart business moves, and these big global health trends all come together, how they create value and tackle really critical health needs.
Exactly. And what's, I think, particularly fascinating about Revenio is seeing how a company that's quite specialized, how it not only survives, but actually thrives in a global market, a market often dominated by much bigger players. We're going to be dissecting the strategic choices they're making. How are they carving out their space and securing their future? We really want to peel back the layers, understand the why behind their success, what makes them tick, what makes them effective, and maybe even more importantly, the what now. Where do they go from here for continued growth and impact? It's a story of precision, really, purpose, and a very deliberate strategy.
Right. So to really grasp Revenio's impact, let's start at the beginning. Who are they, fundamentally? What's their core business? Okay, Revenio Group.HE, Finnish health tech, specialized. And they've really cemented themselves as a global leader in certain key niches of ophthalmic diagnostics. Their main operating brand, the one most people might recognize, is iCare. It's becoming quite synonymous with innovative eye screening. Their mission is, well, it's clear and really important: develop user-friendly, reliable screening tools. Tools for catching those major sight-threatening diseases early. We're talking glaucoma, diabetic retinopathy, AMD, age-related macular degeneration. These are the big ones. Conditions that, if you don't catch them early, can lead to, severe permanent vision loss. So their focus is all about early, accessible diagnosis, prevention.
And their product lineup, while focused, it's very strategically put together. It covers critical diagnostic needs, several key categories. First, and maybe the foundation of their brand, are their tonometers, devices for measuring intraocular pressure, IOP. Absolutely essential for glaucoma screening. Glaucoma, the silent thief of sight, no symptoms early on. These tools are vital. Then, beyond tonometers, they have advanced fundus imaging systems. Think iCare DRS Plus, the IDON family. Basically, these are sophisticated cameras taking detailed pictures of the retina, the back of the eye. Crucial for things like diabetic retinopathy, where diabetes damages blood vessels, and AMD, which hits your central vision. Their EDON devices, for example, they capture true color, really wide field images, and often without needing dilation drops, which is a huge plus for patient comfort in clinic workflow.
Yeah, nobody likes those drops.
Exactly. They also provide perimeters, like the iCare MAIA. These test your visual field, map out your vision, detect blind spots. Again, critical for tracking glaucoma, macular diseases. And looking ahead, they're pushing more into clinical software, integrating all the data from these devices, making it smarter. If you connect this to the big picture, the global population is aging, chronic diseases like diabetes are rising, these early detection tools, they're becoming absolutely indispensable. It's a fundamental growing need they're tapping into.
That really paints a clear picture of their ecosystem. Okay, so what makes Revenio special? In a market that's, let's face it, competitive and fast-moving, what's their secret sauce? The sources we looked at really hammer home Revenio's technological moat, that sustainable advantage, and it's particularly strong with their handheld tonometers. This isn't just a small improvement, it's built around their patented rebound technology. It really changes how eye pressure is measured. Picture this: a tiny, lightweight probe, single use. It just makes momentary, really gentle contact with the cornea, gets the reading super quick. Takes like less than a second. Minimal training needed for the clinician, which is key. And here's the kicker: no anesthetic eye drops needed. None. Think about that for the patient experience. No waiting for drops to work, no blurry vision afterwards. For kids, nervous patients, anyone short on time, it's a massive improvement. Makes eye checks less of an ordeal, more routine, which means people are more likely to actually get checked early. So what does this mean competitively? It's not just a product feature. It's a better experience, a more efficient process. It changes who can do these tests, how often. It democratizes screening, really. That's powerful.
Absolutely. And it's not just clever tech, it's clinically proven.
Yeah.
Over 200 peer-reviewed studies back it up. Its efficacy, its benefits. This validation has cemented iCare as Well, the market leader in handheld tonometry, no question. It speaks to the reliability, the accuracy, the patient friendliness. It works in all sorts of settings, optometrists, GPs, even self-measurement at home now. And these innovations, they feed right into those powerful, non-cyclical tailwinds driving the whole ophthalmic market. Like I said, aging population means more age-related eye disease. That's baked in. Diabetes rising means more need for retinal screening. Again, baked in. These trends aren't going anywhere. Revenio's tech is just perfectly positioned to meet these growing needs, which, of course, raises the question, how do you maintain that leadership in a field moving this fast with big competitors? How do you stay ahead?
That's the perfect transition. Because maintaining leadership isn't just about tech, it's also about smart business strategy. And Revenio's made some really significant positive changes in how they make money. Let's zoom in on that. Traditionally, they relied mostly on selling the equipment itself. One-time capital sales, tonometers, cameras, perimeters. Profitable? Sure. But that kind of revenue can be, well, lumpy, cyclical, depends on clinic budgets, big purchase decisions. But the sources clearly show a big strategic shift. They're moving deliberately towards a more balanced model, with a much bigger slice of recurring revenue, predictable income. And this isn't just a minor adjustment, it's fundamental. It makes their earnings higher quality and more predictable. It makes the whole business more resilient.
Oh, absolutely transformative.
Yeah.
This pivot to recurring revenue, it shifts them from just selling boxes to building ongoing relationships. And predictability, let's break down those streams. The biggest and probably the cleverest is that classic razor and blades model.
Right. Sell the razor, keep selling the blades.
Exactly. For Revenio, the iCare tonometers are the razors. And those essential, single-use disposable probes, those are the blades. Every single measurement needs a new probe. So you get this continuous stream of high-margin consumable sales, tied directly to how many devices are out there and how much they're used. The bigger the installed base, the bigger and more predictable that revenue stream becomes. It's quite ingenious. And beyond probes, they get other recurring sources growing fast. Software licenses, increasingly subscription-based, SaaS models, service contracts for the devices. And as their AI gets stronger, they're starting to generate revenue from AI-powered analysis reports from the diagnostic images. The numbers back this up. Recurring revenue was nearly a third of total sales in FY24. And management explicitly expects that share to keep growing. The benefits? It de-risks the business, smooths out results, improves visibility into future earnings, and it positions them as more of an integrated eye care solutions provider, not just hardware. That usually earns a higher valuation in the market, too.
That makes perfect sense. A much more robust model. Okay, what about their reach? Where are they actually selling these things? Where's the focus? Sources show they're global, over 100 countries. But sales are definitely concentrated in developed markets. North America is huge for them, really critical. It was, 52.9% of net sales in 2023? And the U.S. alone was nearly 49.7% in 2024. So the U.S. is clearly their powerhouse market. EMEA, Europe, Middle East, Africa is next, then APAC, Asia Pacific. Now, being global is great, but relying so heavily on one market like the U.S., that carries some geographic risk, doesn't it? So diversification has got to be important for them long term.
You've hit the nail on the head. Diversification is absolutely key when you're that concentrated, which is why their latest expansion news is so incredibly significant. They recently got marketing authorizations in China for both their advanced iCare Don fundus cameras and the iCare IC200 tonometer. Now, what's fascinating here isn't just another market, it's China, a massive potential market, especially for their high-end products. Huge population, growing healthcare needs, rising middle class. Getting regulatory approval there is tough. Really rigorous, time-consuming. So landing this, it's a big validation of their tech and their operational strength. It's a crucial step strategically to lessen that dependence on the U.S. Gives them a major new growth avenue. Could be really impactful for years to come.
Okay, that makes sense. A big strategic win. Let's pull back again. Look at the wider ophthalmic diagnostic market. What are the big forces driving demand for these kinds of devices? Our sources consistently point to healthy growth. The global market's expanding at, say, mid-single digits, somewhere in that 4% to 8% CAGR range. And it's driven by some really powerful long-term trends, secular drivers. First, the obvious one, the aging global population. It's simple demographics. Older people have a higher risk of glaucoma, AMD, cataracts. As the world ages, the number of people needing eye checks just keeps growing. It's a constant tailwind. Second, lifestyle diseases, especially diabetes. The global rise in diabetes is fueling huge demand for retinal screening because of diabetic retinopathy, a major cause of blindness. So more diabetes means more need for fundus imaging.
Direct link.
Third, technology itself. AI and machine learning are making diagnostics more accurate, more automated. Connected devices enable teleophthalmology remote consultations. This creates new possibilities, new markets, especially for portable, smart tools like Revenio's. And finally, healthcare system pressures, rising costs, staff shortages. This pushes demand towards solutions that are fast, efficient, easy to use. That's where iCare really fits in, right? User-friendly, portable, can be used in more places, primary care, pharmacies, not just specialist clinics, takes pressure off the system.
Precisely. And connecting that back, Revenio's focus on ease of use, portability, and now AI. It slots perfectly into solving those system pressures, enabling earlier detection in more accessible places that can reduce the burden on specialists, potentially cut long-term costs by preventing blindness. It's a strong value proposition.
Yeah.
Which brings us back to that question. How does Revenio, being more specialized, actually compete effectively against the giants, the big players with huge resources?
Yeah, the competition. It's definitely a factor. We're talking big names. Carl Zeiss, Meditech, Topcon, Nidec, Alcon, Homa with their Keeler brand. These are huge, diversified companies, global reach, deep pockets. But Revenio's strategy isn't about matching them everywhere. It's about niche dominance. Their advantage, their moat, comes from that deep tech expertise and market leadership in specific areas, especially handheld tonometry. They're not trying to build the biggest, most complex machine for every single eye condition. They're winning in the efficient, accessible screening space, democratizing it, like we said. And the proof's in the pudding, right? Their revenue growth at CGR of around 27% between 2016 and 2022, that blows the overall market growth of 4 or 5% out of the water. It clearly shows they were taking share. So for you listening, the takeaway is smart focus can beat sheer size. Specialization, innovation, user experience, that can carve out a really strong position.
And you can't talk about this market without digging into the regulatory side. It's definitely a double-edged sword. On one side, yeah, it's complex. Stringent rules from the FDA in the US, the EU's MDR. It means huge investments in clinical data, quality systems, documentation, ongoing monitoring. It's a major operational hurdle.
A barrier, basically.
Exactly. But that's the other edge of the sword. That very complexity, the cost, the time. It acts as a massive barrier to entry. Protects established players like Revenio. It makes it really hard, slow, and expensive for new companies, especially startups, to jump in and compete seriously. Helps preserve market share, pricing power for the incumbents. And Revenio has a good track record here. They navigate it well. Getting FDA clearance for the iCare Home E2 self-tonometer in 2022 was big. Opened up home monitoring in the US. More recently, FDA clearance for the iCare MAIA microperimeter, March 2025. Expanding their advanced diagnostics in the US. But it costs money. Remember that Q1 2024 example. EUR 0.6 million just for one FDA application for the iCare Weenie platform hit their operating margin directly that quarter. But what's really interesting is that regulatory success isn't just a license to sell. It's a stamp of approval. Validates their R&D, their quality, their operational strength. Tells clinicians these devices meet the highest standards.
Right. It's a hurdle, but also a validation. Okay, let's dive into the financials. How have they actually performed numbers-wise over the last few years? Looking at revenue, FY22 was EUR 97.0 million. FY23 dipped slightly on paper, EUR 96.6 million. But that was mostly currency headwinds, right?
Yeah, the strong euro against the dollar hit the reported numbers.
Right. Currency adjusted, they actually grew 2.2% that year, showed underlying resilience. Then FY24, a return to stronger growth, EUR 103.5 million, that's up 7.2%, reported 5.9% currency adjusted.
So, okay, the picture is navigating currency, showing resilience, and getting back to solid growth.
Exactly. And that resilience really shows up when you look at profitability, though the story there is about strategic investment. First off, their gross margins are exceptional, really consistent. 70.7% in 2023, 70.5% in 2024, rock solid. That points to strong pricing power for their tech, efficient production. They control their costs well relative to price.
Very high margins.
Very. But you do see some compression lower down. Operating margins, EBITDA margin went from 34.1% in 2022 down to 29.2% in 2024. Adjusted EBIT margin, which gets a cleaner view of core operations, also dipped 28.3% in 2023 to 25.1% in 2024. Now, crucially, this isn't necessarily a red flag. The sources are clear. It's a conscious strategic choice. They're deliberately spending more, upping investment in sales and marketing for new launches, market expansion, investing in IT infrastructure for that connected ecosystem, and keeping R&D spending high, around that 10% mark, that Q1 FDA cost we mentioned. Perfect example of growth OpEx, spending now to unlock future revenue. So what's fascinating is seeing those stable, high gross margins combined with higher operating spending for growth. It signals a healthy, deliberate investment plan, not eroding fundamentals. Management's betting on the future.
Okay, that makes sense. Spending money to make money, essentially, investing for the future. How solid is their overall financial footing then? Cash flow, balance sheet. They seem incredibly strong there.
Wow.
Operating cash flow more than doubled in 2024, jumped to EUR 23.9 million from 10.9 million the year before. Mostly better work capital management, getting cash in faster.
Very efficient.
And the balance sheet looks bulletproof. Equity ratio was 76.2% at the end of 2024. Very stable, mostly equity financed. And here's the really interesting part. They're net cash positive. EUR 20.7 million in cash, which is more than their total debt. That gives them a negative net gearing ratio, negative 7.3%. I mean, think about that. More cash than debt. It's like having zero debt and money in the bank, that kind of financial strength. It gives them massive flexibility, fund growth, make acquisitions without borrowing heavily, ride out any bumps in the road. Huge advantage.
Huge advantage. It really underpins their ability to execute that strategy. And the latest pulse, Q1 2024, it was a soft start revenue-wise, 1.8% reported growth, slight dip currency adjusted, but that was kind of expected, timing of orders, seasonality. But even with softer sales, operating cash flow is super strong that quarter. EUR 4.6 million shows the underlying engine is still humming. Looking ahead, their guidance for fiscal 2025 is pretty confident, 6% to 15% currency-adjusted sales growth, wide range but positive. And profitability expected at a good level, excluding one-offs. So, connecting that back, Q1 was a blip, guidance signals confidence. They expect those investments to start paying off.
Right. So with that solid foundation and confidence, let's look more closely at that future plan. How exactly do they plan to grow? What's the strategy for 2024 to 2026? Our sources outline this vision towards connected and predictive eye care pathways. It's about moving beyond just diagnosis to proactive prevention. Pretty ambitious. Built on 5 pillars. 1, targeted product innovations. Keep launching new, better hardware. Stay cutting edge. 2, connected and predictive solutions. This is key. Build that ecosystem. Devices talking to software, using AI for prediction, optimize care. 3, enhance customer focus. Better products, better service. Build loyalty. 4, people and culture. Invest in their team. Foster innovation internally. And 5, sustainable and profitable growth. Grow responsibly, long-term. And they're putting their money where their mouth is on R&D, consistently around 10% of sales. Split roughly 23 hardware, 13 software right now. That investment led to launches in 2024. The iCare SD500 slit lamp tonometer, new veterinary tonometers, the MAIA microperimeter, expanding the toolkit. And they're pushing hard on that connected ecosystem. The iCare LOME screening platform, integrating hardware, cloud, AI. Rolling that out, big step towards predictive care. So what does it all mean? It's a clear roadmap. Innovate, connect, expand, solidify their leadership in smart eye care.
And that roadmap isn't just organic growth. Acquisitions are playing a key role in speeding things up. The big one recently, Thesis Retina BV, acquired August 2024. This wasn't just adding a product line, it was a strategic accelerant.
An accelerant, okay. How so?
It instantly boosted their transformation into a software and AI player. Thesis is a Dutch specialist in AI for ophthalmology. They brought valuable tech, IP, and crucially, an experienced AI team, a ready-made brain trust. Their main product, RETCAD, uses AI to screen fundus images for diabetic retinopathy, AMD, glaucoma. And the key move, they're integrating RETCAD directly into Revenio's iCare Illumi platform. This makes Illumi way more powerful, more automated, more comprehensive. And it directly fuels that shift to recurring revenue paper analysis subscriptions, makes the platform stickier, more valuable. It was a really smart move. Instead of spending years building AI from scratch, they bought a leading capability. Shows confidence, strategic thinking, and management says they're still actively looking for selected and focused M&A, backed by that strong balance sheet. So expect more strategic buys, perhaps.
That Thesis deal sounds like a textbook strategic acquisition, using their financial strength wisely. Okay, so how do they balance all this investment with returning value to shareholders? What's their capital allocation philosophy? Seems like a balanced approach. Priority 1 is clearly reinvesting in the business. That 10% R&D spend funding acquisitions like Sirona, that's about fueling long-term growth. But shareholder returns are pillar 2, mostly through dividends. They have a great track record, 10 years paying, 6 straight years of increases. Proposed EUR 0.40 per share for 2024, up from 0.38. Policy is sustainable dividend, but with flexibility for M&A. Growth investment still comes first if the right deal appears.
Right. Growth is a priority use of cash if the opportunity is compelling.
They also use share-based incentive plans for the leadership team. Performance share plans, restricted share plans, ties executive pay to long-term company performance, aligns interests. So this raises the question, what does this capital allocation strategy tell us about their confidence and maybe their risk appetite?
It signals strong confidence in future growth, definitely. They believe the investments they're making now will generate significant returns down the line, even if it means slightly lower margins temporarily. But it's also disciplined. They're not just throwing money around. The dividend shows a commitment to shareholder returns too. Now, who's actually running the show? And what are the potential speed bumps they need to watch out for? The leadership seems solid. CEO Juni Toihala, CFO Robin Pulkkinen. The wider team has diverse experience from big names Nokia, McKinsey, Specsavers, Varian, good mix of tech, strategy, operations. Oversight comes from a strong independent board, chaired by Arne Boye Nielsen from DuMont. Other members from Novartis, Alcon, Thermo Fisher. Real industry heavyweights. They adhere to Finnish corporate governance code. Seems like robust governance is in place. Okay, experienced team, good oversight, that's crucial. Absolutely. But even with strong leadership, there are risks. Key ones to be aware of. Financially, FX volatility is a big one. Half their revenue in USD means Euro-USD swings can really impact reported results, masking underlying performance sometimes. Also, geopolitical risks. That heavy U.S. reliance makes them potentially vulnerable to things like import tariffs, which could squeeze margins despite mitigation efforts.
Operational risks.
Yeah. R&D execution. Growth depends on innovation. Delays, poor clinical results, regulatory setbacks, those would hurt. Supply chain. Getting those specialized electronic components. Shortages or price hikes could impact production, margins, and acquisition integration. Making Therona work smoothly, realizing those synergies, that takes effort. Future deals carry similar risks.
And strategically, market risks.
Intense competition. Those big players could always put pressure on pricing or innovate faster. And regulatory changes. Stricter rules in the US or EU could increase costs, slow down new product launches. So, understanding these risks is vital. It helps assess the resilience, the potential challenges to that growth story. It's about seeing the whole picture, warts and all.
Definitely need to balance the opportunity with the risks. Okay, finally, how does the market see Revenio? You mentioned a premium valuation. What does that actually mean? Looking at the multiples as of late 2025, TTM PE ratio around 34-36x, price to sales about 6.1x, adjusted EBIT for FY24 estimated around 24x. These are, well, pretty high numbers. The sources say they reflect high expectations for future earnings growth and sustained profitability. The market is betting big on their future success.
Pricing in a lot of growth.
Yeah, if you compare them. Revenio's market cap around 767 MUSD, those multiples. Compared to a smaller peer like Ophthalmic, Revenio is way higher, reflecting its profitability. Even against giants like Zeiss Meditech or Halma, while their market caps are much larger, Revenio's PE is often similar or even higher, despite being smaller. So what's the takeaway for someone looking at this? The market has already priced in a lot of good news, expects them to keep outperforming the market significantly.
Exactly. That high valuation, it's a badge of honor in a way, a testament to their quality, their moat, those strong secular trends. But it creates a delicate balance. It means expectations are sky high. There's very little margin of safety if things go wrong. Operational hiccups, competitive pressure, external shocks, they could hit the stock hard. Analyst commentary confirms this. They say the valuation demands earnings growth, requires successful execution on many significant steps.
No room for error, basically.
Pretty much. And remember their own goal. Grow 3 times faster than the overall market from 2025 onwards. If they hit that, maybe the valuation holds. But if they miss, the current price basically assumes their big strategic bets, especially AI, connected care, pay off handsomely. Any failure to deliver could lead to a significant derating. So the question for you, the listener, becomes, how confident are you in management's ability to execute flawlessly, to consistently meet these very high expectations in such a complex, dynamic field?
We have really covered a lot of ground today on Revenio Group, from that core rebound tech, the smart shift to recurring revenue, how they compete, their financials, right through to those high market expectations. You should now have a really comprehensive view of this specialized leader in eye diagnostics, a company trying to prevent vision loss worldwide. We've seen how critical a clear strategy, good tech, solid financials, and disciplined execution really are in this space.
And maybe a final thought to leave you with. Revenio's push towards connected and predictive eye care pathways. Think about that. It's not just about selling devices. If successful, it could fundamentally change how we detect and manage eye disease globally, moving from treating problems to proactively preventing them. Which raises a bigger question. If AI and connected diagnostics become commonplace for saving sight, what does that mean for public health overall? And what other areas of medicine might adopt this predictive model, changing proactive healthcare for everyone? Something to think about.
Definitely something to think about. Thank you for joining us on this deep dive.